In November 1999, one of the most powerful analysts on Wall Street changed his recommendation on a company. Billions of dollars moved. Investors followed. Funds adjusted positions. The market reacted. And the real reason had nothing to do with the company. It had to do with a preschool. That sounds ridiculous. It should. Because we're taught that markets move on information. Research, data, fundamentals. The idea that a stock recommendation could be connected to a toddler's preschool application sounds more like a conspiracy theory than financial history. But that's exactly why this story matters. Because if markets are really driven by analysis, then the preschool shouldn't matter. And if the preschool does matter, then what else are we misunderstanding? Most people assume markets are giant machines processing information. Millions of investors analyzing data, thousands of professionals studying companies. The smartest minds on Earth competing to find the truth. That's the story we're told, and it's a good story. The problem is that sometimes the real story is happening somewhere else entirely. In November 1999, Jack Grubman, one of the most influential telecommunications analysts on Wall Street, upgraded AT&T from neutral to buy. This wasn't a small call. When Grubman spoke, billions of dollars moved. Funds adjusted positions, institutions followed. The market listened. And the reason given was simple. A fresh look at fundamentals, fiber optics, industry outlook, a revised assessment of value, a normal explanation, a reasonable explanation, and that's exactly what made it dangerous. Because the truth uncovered later had nothing to do with any of that. When people talk about the dot-com bubble, they usually explain it in one word. Hysteria, a collective breakdown, millions of investors suddenly losing their minds at the same time. And that explanation feels satisfying. Because it removes responsibility. If everyone was irrational, then no one in particular was wrong. But here's the problem with that story. The crowd didn't design the game, they just played it. And once you look at the system itself, something uncomfortable becomes obvious. The behavior wasn't random. It was structured, rewarded, reinforced. In early 2000, the NASDAQ was racing toward 5,000. A 15-year-old internet company had just bought one of the most powerful media empires on Earth. And nobody called it absurd. They called it inevitable. Every signal in the environment pointed in the same direction. The future had arrived. The old rules no longer applied, and questioning that narrative started feeling riskier than believing it. Imagine walking into a casino. The lights are flashing. The drinks are free. The winners are displayed on screens everywhere. The losers are invisible. The staff keeps telling you you're just one lucky spin away. And every signal in the environment tells you the same thing. Keep playing. So you do. And when you eventually lose everything, the explanation comes easily. You were irrational. But that ignores the design of the environment itself, because the environment was never neutral. It was engineered to produce participation. That's the part most people miss when they look back at bubbles. They focus on the people who played the game, not the people who built it. And once you shift the focus upward, the entire story changes. Analysts issued buy ratings on companies they privately questioned. Banks collected fees for every deal they underwrote. Media ran the story because the story got attention. Everyone was moving in the same direction. Not because they agreed, because the structure rewarded alignment. And in that kind of system, disagreement isn't punished. It's isolated. And isolation is expensive. So people adapt. Not out of confusion, out of pressure. Which means the crowd was not the origin of the behavior. It was the output. A reflection of incentives moving through the system. And once you understand that, the entire hysteria explanation starts to fall apart. Because hysteria implies emotion without structure. What actually happened was structure producing predictable behavior. So if the public wasn't the problem, what were the people designing the game actually saying when nobody was listening? An institutional client once asked him directly about GoTo.com. A simple question. What's interesting about it? You're recommending it. There must be something. Some insight, some edge, some reason. His private response was one word. Nothing. Not a paragraph, not a valuation model, not a thesis, just nothing. And that word should end every conversation about whether the analysts were simply wrong. Because you can be wrong about something you believe in. You cannot be nothing about something you believe in. Not at that level. Not with that confidence in public. Not with that influence on capital flows. That is not misunderstanding, that is separation. And the separation wasn't hidden. It was just never expected. Because we assume people who speak with confidence in public believe what they're saying. Grubman sounded convinced enough to move markets, Blodgett sounded convinced enough to go on television, but in private, the opinion was different. And that gap between the public voice and the private view is not a personality flaw. It's a structural feature. Because what this reveals is not just one analyst behaving differently in private, it reveals a system, a dual narrative machine. One story built for public consumption, another built for private reality. One version designed to create demand, another version designed to manage truth. And the important detail is not that the two narratives are different. It's that they are allowed to coexist, because they serve different functions. The public narrative creates participation, the private narrative manages risk, and the gap between them is where the system operates. This is why the dot-com bubble was so difficult to recognize in real time. By the time information reached investors, it had already been processed into something that sounded reasonable, clean, defensible, safe. And that safety is exactly what made it dangerous, because it removed friction, it removed doubt, it removed resistance. And without resistance, momentum compounds. So if the private view was so different from the public one, why keep pushing the public version forward? The answer turns out to have almost nothing to do with dishonesty, and everything to do with something far more ordinary. Survival. At this point, most people assume the smartest investors win. The best analysis wins, the best research wins, the best judgment wins. But inside the bubble, something else was deciding outcomes, something far less visible. Two fund managers can look at the same market, see the same overvaluation, see the same risks, reach the same conclusion, and still behave completely differently. One stays out, one joins in, not because they disagree on facts, but because they disagree on survival. Think about that. Two people with identical information, identical analysis, identical conclusions about risk, and still completely different behavior. Not because one is smarter, because one has a different answer to the question nobody asks out loud. How much pain can I absorb while waiting to be proven right? Because the real question was never what is correct. It was, what can you survive? This is where the system becomes visible. If you were a fund manager in 1999 and you avoided the bubble, and the market went up 100% without you, you didn't look disciplined. You looked incompetent. You lost clients, you lost credibility, you lost your job. But if you participated in the bubble and it collapsed later, you didn't look alone. You looked normal. You failed with everyone else. And that difference is everything. Because in markets, being wrong in a crowd is survivable. Being right alone is survivable in science. In markets, it can end your career. This is where the Asch conformity experiment becomes relevant. Participants were shown a simple visual test. One line clearly matched another. The answer was obvious. And yet, when everyone else in the group gave the wrong answer, people started denying what they could physically see. People were willing to deny a line they could physically see just to avoid standing alone. Now replace a line on paper with your career, your income, your reputation, your mortgage, your family watching you. How wrong would you let yourself look before you sat down with everyone else? That is the real mechanism. Not confusion, not ignorance. Pressure. And pressure scales. Because in institutional finance, nobody is just making a decision. They are making a decision relative to everyone else making the same decision. And that creates convergence, not toward truth, toward safety. Which is why even sophisticated investors stayed in the bubble long after they understood the risks. Because leaving early was indistinguishable from being wrong. And being wrong early is indistinguishable from being wrong completely. Jeremy Grantham understood this better than most. His firm identified the bubble early. The valuations were irrational, the signals were clear, the risks were obvious, so they stepped back, and they paid for it immediately. They lost nearly 40% of their clients, not because they were wrong, but because they were early. And in markets, early is just another word for wrong until time proves otherwise. Grantham was right, but his business almost died from being right. And that is the cruelest design flaw in the entire system. It punishes honesty and rewards participation. Not because people are evil, but because the structure makes survival and integrity incompatible, at least temporarily. Which is why the real story of the bubble is not about intelligence, it is about alignment. And once you see that clearly, one question becomes unavoidable. How many of your own decisions were shaped not by what you believed, but by what you knew you could survive believing? Imagine spending 5 years building something, not writing code in a garage, not making slides for investors, actually building, digging, laying, connecting, crossing oceans, crossing deserts, creating something that will literally hold the future together. and then watching the future arrive and realizing you won't be in it. Not because you failed, but because you arrived slightly too early and paid slightly too much. And the person who shows up after you, after your company is gone, after the bankruptcy, after the lawyers, plugs into everything you built for almost nothing and becomes a billionaire. That is not a metaphor. That is what happened. Because one of the strangest truths about the dot-com bubble is this. The companies that built the internet largely died. The companies that used the internet became some of the most valuable businesses in human history. At first, that doesn't make sense. If the internet was the future, shouldn't the people building it have won? That's what everyone believed, including the people spending hundreds of billions of dollars trying to create it. Two of the biggest believers were Bernie Ebbers of WorldCom and Gary Winnick of Global Crossing. These men weren't building websites, they weren't launching apps. They were building the physical foundation of the digital age. The pipes, the highways, the infrastructure underneath everything. Miles of fiber optic cable stretching across continents and oceans, the invisible system that would allow information to move around the planet at the speed of light. And the vision was real. That's the important part. The vision was absolutely real. The internet was growing. Demand was increasing. The world was becoming connected. They weren't building a fantasy. They were building the future. But there was one problem. Everybody was building the future at the same time. So companies borrowed, then borrowed more, then borrowed even more. By the peak of the bubble, the telecommunications industry had accumulated roughly $500 billion in debt. To put that in scale, that is more than the entire GDP of most countries. Borrowed, in less than a decade, on the assumption that the future would arrive fast enough to pay it back. And for a while, that looked brilliant. Investors loved it. Analysts loved it. Wall Street loved it. The future was arriving. The money was flowing. The story made sense. Until reality introduced a small complication. The future arrived slower than expected. Not slower forever. Just slower than the debt payments. And that difference destroyed everything. Because the technology wasn't the problem. The internet wasn't the problem. The demand forecasts weren't even completely wrong. The problem was that everyone was racing to build capacity before everyone else. The logic seemed undeniable. If the future was coming, whoever built first would win. So everyone built, at the same time, on borrowed money. And when everyone races to solve tomorrow's problem today, they create a different problem entirely. Too much capacity, too much debt, too many companies trying to be first. The future eventually arrived. But it arrived into a market that had already overbuilt itself. And debt doesn't care whether you're early or wrong. It demands payment either way. That's why the economics collapsed. Not because the technology failed, because success arrived too slowly. Prices crashed, revenue collapsed, debt remained. And one by one, the builders disappeared. WorldCom collapsed, Global Crossing collapsed, billions vanished, then tens of billions, then hundreds of billions. The technology worked. The prediction was right. The timing was fatal. And the people who inherited the infrastructure they didn't pay for, they had different names by then. Google, Amazon, the companies we now call visionaries, arrived second. They just arrived with better timing and someone else's foundation, which creates a problem that goes deeper than debt, because the infrastructure builders at least had something real: steel, cable, physical assets. But underneath the bubble, another layer of companies was being valued on something far less tangible. Not infrastructure, not earnings, not even revenue. Just the idea that if enough people were looking, the money would figure itself out eventually. They called it eyeballs. At some point in 1999, Wall Street stopped asking a very important question. Is this company profitable? And replaced it with a completely different one. How many people are looking at it? The metric was called eyeballs, user attention, site traffic, page views, visitors. And if your eyeball count was growing fast enough, almost nothing else seemed to matter. And the logic wasn't entirely wrong. The internet was creating audiences at a scale the world had genuinely never seen. Attention was becoming valuable. That part was real. The problem was the next step, because once attention became the story, profit became optional. And optional became irrelevant. And irrelevant became invisible. The future belonged to whoever could attract the most people the fastest. And honestly, the idea sounded reasonable. The internet was creating audiences on a scale the world had never seen before. Millions of people could suddenly gather in one place. One website, one platform, one network. Attention was becoming valuable. And that part was true. The problem was what happened next. Because once attention became the story, profit stopped being the test. Imagine opening a restaurant. You lose money on every customer. You have no path to profitability, no sustainable business model. And when investors ask how much money you're making, you respond, "We had 300,000 people walk through the front door this month." That's essentially what was happening. Attention became a substitute for economics, and Wall Street loved it. Because attention is flexible, profits are not. Profits force reality into the conversation. Attention allows imagination to take over, and imagination is much easier to sell. Suddenly, companies with no earnings could be worth billions. Companies with no profits could be called revolutionary. Companies with no proven business model could become market darlings. The story was simple. First, capture attention, then figure out how to make money later. The future would solve the details. The problem was that the future hadn't arrived yet, and somebody still had to pay the bills. Which created a very awkward question. If profits didn't matter, where was all the money coming from? That's where things get interesting, because underneath the excitement, underneath the user growth, underneath the endless talk about eyeballs and page views, a different machine was keeping the system alive. Vendor financing. On the surface, it looked harmless, even clever. Telecommunications companies weren't just selling equipment and network services. They were lending money to customers so those customers could buy more equipment and network services. Think about that for a second. I'll lend you money. You use the money to buy from me. I record revenue. Investors see growth. I raise more money. Then I lend more money. The loop repeats. It looked like demand. But demand and financing are not the same thing. Real demand comes from customers. This demand came from the system itself. Money was moving in circles, and every time it completed another lap, it looked like growth. Revenue increased, forecasts increased, valuations increased, confidence increased. Everything appeared healthy, because the numbers were technically real. But the underlying engine wasn't. The system had quietly started feeding itself. And that's the danger of every bubble. Reality gets replaced by proxies. First, profits are replaced by eyeballs. Then demand is replaced by financing. Then valuation is replaced by momentum. And eventually, nobody notices the substitutions anymore because each step sounds reasonable on its own. That's what makes bubbles so difficult to recognize from the inside. Nobody wakes up and decides to abandon reality. Reality gets replaced gradually, one reasonable explanation at a time, one new metric at a time, one exception at a time, until eventually the entire system depends on things that cannot survive without constant belief. And belief is fragile, because once investors start asking about profits again, eyeballs stop being enough. Once investors start asking where the revenue comes from, vendor financing stops looking clever. Once investors start asking whether growth is real, the loop breaks. And when the loop breaks, the entire structure starts searching for reality again, usually all at once. Because once money stops entering the system, belief loses its support structure. And when belief loses its support structure, prices begin searching for something they haven't needed in years. Reality. Markets don't collapse when people realize something is overvalued. They collapse when people stop being able to sell it to someone else. That's the difference. And it's the difference almost everyone misses when they look back at the dot-com bubble. Because by the time prices started falling, the arguments about valuation were already over. The real question had changed. Quietly, almost invisibly. For years, investors had been asking, is this going up? Now they were asking something else. Who is going to buy this from me? And those are not the same question. Picture a fund manager in March 2000. She's been skeptical for months. She trimmed exposure in January. She was early, too early. Her returns lagged. Clients complained. Competitors kept outperforming. So she added exposure back. Not because she changed her mind, because the pressure became unbearable. Now it's March, and she's watching the market behave differently. The rallies are weaker. The recoveries are slower. The bids are thinner. She knows what this is. She's seen versions of it before. But she also knows something else. If she sells now, and the market rallies for another 6 months, her career may be over. So she waits. Not because she believes. Because waiting feels safer than being wrong alone. That's not panic. That's survival math. And it's happening simultaneously across the entire system. This is how liquidity disappears. Not with a dramatic announcement. Not with a single catastrophic event. With hesitation. A fund delays new purchases. An institution reduces risk. A portfolio manager becomes slightly more cautious. Each individual decision seems insignificant. Together, they change everything. This is the moment that defines every bubble's ending. Not the moment people stop believing. The moment people stop finding buyers. That is what a liquidity trap actually is. Not a collapse in confidence, but a collapse in the assumption that confidence was ever enough. Because when enough people begin thinking about the exit at the same time, the exit itself becomes the problem. The buyers become slower, the bids become thinner, confidence becomes fragile, and then the cycle reverses. The same investors who ignored fundamentals begin demanding them. The same investors who celebrated growth begin asking about profits. The same investors who paid for possibilities begin demanding proof. Nothing changed inside the companies. The internet still worked. Traffic was still growing. The future was still arriving. What changed was the flow of money. And once that flow slows down, everything built on it becomes vulnerable. Not because the story was completely false, because the story required constant reinforcement, and reinforcement requires new capital. Because once money stops entering the system, belief loses its support structure. And when belief loses its support structure, prices begin searching for something they haven't needed in years: reality. Which is where the collapse truly begins. Because liquidity doesn't disappear all at once. It disappears just enough for the first people to notice, then the second, then the third. And eventually everyone reaches the same conclusion at exactly the same moment. There aren't enough buyers. And once that realization spreads through the market, the crash is no longer an event. It's a chain reaction. At first, it doesn't look like a collapse, just a correction. A few bad days. That's what they always say. Until the recovery doesn't come. A stock falls and stays down. A rally starts and fades. A recovery comes and nobody follows it. Something feels different. Not dramatic, just weaker. The buyers are slower. The bids are thinner. The confidence is less automatic. And that is enough. Because collapses don't begin when people panic. They begin when people hesitate. One fund decides to reduce exposure, therefore prices fall. Another fund sees the decline and reassesses risk, therefore it reduces exposure too. A third fund hits internal limits, therefore forced selling begins. Now the selling itself becomes information. Price is no longer a signal of opportunity. Price becomes a signal of danger. And danger spreads faster than optimism ever can. This is the collapse cascade. Not one event, a sequence, a chain reaction where every action creates the reason for the next action. The first sellers create the conditions that produce the second sellers. The second sellers create conditions that produce the third, and the cycle feeds itself. At first, it seems isolated. Internet stocks fall. That makes sense. They were the most speculative. Then profitable technology companies start falling. Then blue chip companies. Then entire sectors. The weakness spreads not because every company suddenly became worse, because the system itself is becoming less willing to hold risk. Funds sell positions, banks tighten lending, investors pull money, risk systems activate. Each action makes sense on its own, and that's what makes it dangerous. Nobody in that system was doing something wrong. Every decision made sense on its own terms. The fund manager protecting her clients, the risk system following its rules, the bank protecting its balance sheet, the investor meeting redemptions, each person doing exactly what they were supposed to do, and together producing something nobody intended. That's not a story about villains. That's a story about a machine that stopped having anyone driving it. The internet was supposed to change everything. Then suddenly people act as if it never would. But neither belief is entirely true. The technology didn't change. The pricing did. Mechanics take over. A lower price triggers selling. The selling creates a lower price. The lower price triggers more selling. The loop tightens again and again and again. The strange part is how quickly the narrative changes. 1 month earlier, people were debating how large the future could become. Now they're debating whether the future exists at all. The internet was supposed to change everything. Then suddenly people act as if it never would. But neither belief is entirely true. The technology didn't change. The pricing did. That's what makes bubbles so confusing in real time. The underlying reality can continue improving while the financial structure built on top of it collapses. The internet still worked. Traffic still grew. More people came online every month. The world continued moving in exactly the direction everyone predicted. But predictions are not enough when the financing structure underneath them breaks. And by the time people realize that, the cascade is already in motion. Not because everyone became irrational, because everyone became rational at the same time. They protected themselves, their firms, their clients, their balance sheets. And those perfectly rational decisions amplified one another until the system could no longer absorb them. The strange part the part nobody talks about, is that the internet kept working through all of it. Traffic kept growing. People kept logging on. The world kept moving online. The technology didn't fail. Only the belief in the pricing of the technology failed. And when belief goes, it doesn't leave slowly. It disappears all at once, like a light turning off. One moment it's there, then it isn't. When the dot-com bubble collapsed, most people assumed the money disappeared. It didn't. The money moved, quietly, from the people who built the dream to the people who survived long enough to buy the wreckage. That's what crashes often are, not destruction, redistribution. The headlines focused on what was lost. The real story was who inherited what remained. And once the dust settled, a different generation of companies stepped into a world someone else had already paid to build. The financial aftermath is straightforward. The money moved from builders to inheritors. That part of the story ends there. But there's another part that doesn't end. And it belongs to the people nobody talks about when they analyze crashes. The people who trusted the system, not the analysts, not the fund managers, not the executives, the ordinary investor. The person who opened a brokerage account, read the research report, watched the interview, listened to the recommendation, and thought, these people know something I don't, because that's what expertise is supposed to mean. Access, knowledge, insight, a better understanding of reality. And here's the uncomfortable part. That trust wasn't stupid, it was reasonable. The research looked like research. The ratings looked like analysis. The experts looked like experts. Everything appeared exactly the way it was supposed to appear. And underneath all of it, incentives were quietly pulling in a different direction. That's the part that changes how you see the entire bubble. Because once you understand the structure, the question is no longer, why did people fall for it? The question becomes, what were they actually being shown? Think about what we've actually seen here. An analyst who changed a recommendation for personal reasons and called it research. Experts publicly endorsing companies they privately mocked. Fund managers who understood the risks and stayed anyway. Builders who were right about the future and lost everything. Valuations built on attention instead of economics, and liquidity that disappeared before anyone realized it was leaving. None of this required stupidity. It only required incentives. And incentives are far more powerful than most people realize, because incentives don't force behavior. They shape it. Quietly, gradually, until the behavior feels natural, obvious, reasonable. Which leads to the only question that really matters. What do you do once you know the system works this way? You stop being a participant in the narrative and become someone who reads it differently. Not cynical, not paranoid, just more precise. You start asking different questions. Not, is this growing? But how is this growth being financed? Not, do the experts believe this? But what are the experts rewarded for believing? Not, is this the future? But who built the foundation this future is standing on and what happened to them? That's the shift. From consuming the story to analyzing the structure underneath it. And that shift is probably the only real protection any investor has. Because every bubble arrives wearing different clothes. Different companies, different technologies, different language, but underneath, the mechanics are usually familiar. The incentives, the narratives, the pressure, the belief, the structure, those parts rarely change. Which is why the most valuable lesson from the dot-com bubble isn't about technology, or stocks, or even investing. It's about understanding the difference between a story and the system producing the story. Because once you can see that difference, you start noticing it everywhere. And once you notice it, you can't really unsee it. The dot-com bubble didn't happen because people were irrational. It happened because the system was rational, and the system was wrong. That distinction matters, because the system hasn't changed. Only the names have.